To check whether a fund's numbers are honest, you ask an outside source to price its holdings. Infinity Q used Bloomberg's valuation service, an independent pricing engine the whole industry treats as neutral. James Velissaris, the fund's founder and chief investment officer, found a way around that. According to the Department of Justice, he secretly altered the code inside Bloomberg's valuation service so it would return the prices he wanted. When investigators added it up, the fund's assets had been overstated by more than $1 billion. This is the story of how a supposedly independent check became something he controlled from the inside. Start with what Infinity Q actually held. The fund traded exotic derivatives including variance swaps and corridor variance swaps. In plain terms, these are contracts that pay off based on how much a market swings, rather than on whether it simply goes up or down. They are complex, they trade rarely, and there is no public ticker you can glance at to see what they are worth. That is exactly what makes them hard to value, and it is exactly why funds lean on an outside pricing service to mark them. When a position has no obvious market price, the model becomes the price. Whoever controls the model controls the number investors see. It helps to picture how a variance swap actually pays. Two parties agree on an expected level of market volatility, a strike. When the contract ends, they compare that strike to how much the market really moved. If actual swings ran hotter than the strike, one side collects. If markets stayed calm, the other side does. The corridor version only counts the days the market traded inside a set price band, which makes the payoff even more sensitive to assumptions. Nothing here is quoted on a public exchange minute by minute. The value on any given day is an estimate built from inputs and a formula. Change the inputs or the formula, and the same contract can be worth wildly different amounts on paper. Here is the mechanism straight from the Justice Department's account. Velissaris mismarked those variance and corridor variance swaps two ways. First, he made false entries into Bloomberg's valuation service. Second, and more brazenly, he secretly altered the code of that service itself. So the tool that was supposed to independently price his positions was quietly rewired to hand back the marks he preferred. To an auditor, to an investor, to a risk officer, the values looked like they came from a trusted third party. They came from him. The independent check and the person being checked had become the same hand. Think about why those two methods together were so effective. A valuation service like Bloomberg's takes market inputs, runs them through pricing models, and returns a number a fund can put in its books. False entries corrupt what goes into that machine. Altering the code corrupts the machine itself. Do only the first, and a careful reviewer might catch a strange input. Do both, and the tool quietly agrees with the lie at every step, because the lie is baked into how it computes. For the Department of Justice, the result was that Velissaris could steer his swap marks toward whatever supported the fund's story, while every downstream party believed they were reading an untouched, independent price. The tampering was invisible precisely because it lived where nobody thought to look. Why do this at all? Follow the fees. According to the Department of Justice, the inflated valuations let Infinity Q report a fund that was far larger and far more successful than reality. On paper, assets ballooned by more than $1 billion. That matters because a fund like this charges two kinds of fees. A management fee taken as a percentage of assets under management, and a performance fee taken as a share of reported gains. Inflate the assets and the reported returns, and both fees swell at once. The investors were charged more for a fund that existed mostly in the marks. Prosecutors found they paid more than $125 million in excess fees they never should have owed. Of that $125 million in excess fees, roughly $22 million went to Velissaris personally, according to prosecutors. That split is worth sitting with. The bulk of the inflated fees flowed through the fund's machinery, charged against investors who trusted the reported numbers. A meaningful slice landed directly in the pocket of the man who had rewritten the numbers in the first place. The overstatement was not an accounting abstraction floating in a spreadsheet. It converted dollar by dollar into money leaving investor accounts. The bigger the lie about the assets, the bigger the bill those investors quietly footed, and the larger the personal take at the end of the chain. A scheme like this survives only as long as nobody has to turn the positions into cash. Marks on paper can drift far from reality, and no one notices until money actually has to move. For Infinity Q, that moment arrived in February 2021. The fund's net asset value, the per-share price that says what your stake is worth, was frozen. Investors who thought they could pull their money found the door shut. Shortly after, the fund began winding down. Once the positions faced a real settlement rather than a friendly model, the gap between the reported values and the true values had nowhere left to hide. When the case moved from the fund to the courtroom, it did not stay in one lane. The Justice Department brought the criminal case in the Southern District of New York. Running alongside it were parallel civil actions from the Commodity Futures Trading Commission and the Securities and Exchange Commission, the two regulators that police derivatives and securities. The Commodity Futures Trading Commission had jurisdiction because of the swaps. The Securities and Exchange Commission had jurisdiction over the fund and its investors. Three separate arms of the government looking at the same conduct from the same records all landed in the same place. That convergence matters. The account of what happened does not rest on one prosecutor's theory. It rests on overlapping filings from agencies that each had to independently justify every claim. In April 2023, the Southern District of New York sentenced James Velissaris to 15 years in prison. The court ordered restitution of almost exactly $126 million. To the dollar, $125,969,962, tracking almost exactly the excess fees investors had been charged. It also ordered forfeiture of $22 million, the amount prosecutors tied to his personal cut. 15 years is a serious sentence for a financial crime, and the numbers in the judgment were not rounded slogans. They were tallied to the dollar from what the fund and its investors had lost. What makes this case worth remembering is where the fraud lived. Most valuation fraud is a lie told about the model. Velissaris told his lie inside the model, editing the code of the very service built to be independent of him. Every safeguard downstream trusted that pricing engine, so corrupting the engine corrupted everything that read from it. The lesson auditors took away is uncomfortable. A control is only as trustworthy as the data feeding it, and the word independent means nothing if the person being watched can reach into the tool doing the watching. The number on the screen is only as honest as the code behind it.